This episode is brought to you by Updater, the app that gets residents move-in ready faster. Did you know that residents who are happy at their move-in experience are 59% more likely to renew their lease? Move-ins matter. So get them right with Updater. Visit go.updater.com/Mike to learn more and receive a special gift when you book a demo. Welcome to Collective Conversations. I'm your host, Mike Brewer, and today we have a repeat guest joining us. Dom Beveridge is the principal at 20 for 20, the go-to consultancy for publisher that connects multifamily operations to the best tech in the industry. Dom, welcome to the show.
Thank you for having me again.
I'm excited. I'm always excited to talk to you. You're always up to something. You're always writing about something that is deeply intriguing and or, dare I say, controversial. I don't know. Maybe today is a little controversial, but I like it.
Sure. Yeah. Always good to write stuff that people will talk about.
Yeah, I think that is true. What is that? What is that principle in marketing? Whether the conversation is negative or positive, just the fact that people are talking about you is a good thing.
Yeah, it's Oscar Wilde, isn't it? There's only one thing worse than being talked about, and that's not being talked about.
That's it. That's much better. Well, so today that lead-in was on purpose because you've published a paper. I think it's your latest 20 for 20 on the topic of revenue management, and it makes reference to the ProPublica article that was written. I think that was like 5 or 6 months ago. My timing might be off a little bit, but I wanted to dig into that. And I guess my lead-off question is, what caused you to kind of want to deeply analyze that particular article and the implications that article makes?
Yeah, so I have a sort of unusual set of sort of priors as far as this is concerned. Just my career background, I've spent most of my career functionally doing revenue management. So like multifamily, in fact, I got into multifamily by way of revenue management. Multifamily was like the 6th industry that I'd been involved in revenue management for. So I've just done a lot of it in my career. So I've done client work across, hotel, passenger rail, air cargo, inclusive tour, just various different industries over the years. So I understand the theory of it really well. Like I've been involved in designing new systems. Like I hold a patent for a market-based pricing solution for the hotel industry. So again, I have a very good understanding of what the technology is doing strategically. And I'm also a private company, right? I don't work for any of the people who are directly affected by these allegations. I mean, one of the things that happens is when you have a bunch of class action lawsuits in an industry, nobody can talk about it. So I sort of look at this somewhat from the sidelines, and I see none of this stuff is true that's being said about the industry, but I also see an industry that can't really defend itself other than through legal methods right now. On my own blog, I've published, critiques that sort of point out what's wrong with various of the allegations that have been made. But over the course of the last few months, a lot of people have reached out to me privately to talk about this. And the thing that nobody's really been able to articulate so far is that these accusations that are being made about the industry doing something that looks like cartel pricing, it's not just that they're not true, they're not even possible. And so when I sat down, this was towards the end of last year, I thought that's an article that needs to get written. I was sitting on a plane, like writing it. I got sort of carried away and just kept. By the time the plane landed, I realized I was about 3,500 words into an article. And I thought, it's possible I've bitten off a little bit more than I can chew here, because if you're trying to explain, if you take the allegations that are being made and that are fundamentally about, there's this cartel pricing thing going on, and you try to explain why that would be impossible, you have to explain industry structure, you have to explain financial incentives, you have to explain strategy, you have to explain seasonality, like the basics of revenue management. You have to explain how the technology works. You sort of have to do all of that work. And so that ended up being something that needed to be written up as a paper.
So there is a lot to unpack there in terms of, let's call it the barriers, right? And I think you kind of sum it up in your paper in terms of supply or even portfolio dynamics, the primary purpose of revenue management, the complexity of collusion. Where do you want to jump off here and maybe kind of walk through those various barriers that sort of underpin the fact that this just can't be a thing?
Yeah, well, so if we start off with a working definition of what a cartel is, right? Because again, that's the thing that the industry is being accused of. So broadly speaking, a cartel is a group of suppliers who manipulate supply in order to make price to change pricing conditions in a market, right? So the go-to example is usually like OPEC, where a highly consolidated group of like nations that produce oil can dial up or down the supply of oil to make oil more or less scarce. And because scarcity drives price, by doing that, they can change oil prices. And basically, what all of these allegations are saying about multifamily is that operators are doing something similar. They're changing supply conditions, and they're doing it in coordination so that they can change, rental housing prices in the markets in which they operate. So, I break it down. And by the way, another thing to mention is this paper is co-authored. Like two of the people whose quotes were used very, very selectively in the original ProPublica article, Donald Davidoff and Jeffrey Roper, who were both instrumental in creating LRO and YieldStar, respectively, because both were kind of keen to set the record straight after that article. They both co-authored this paper with me. It's also just, if you're writing something fairly definitive about revenue management, you also want some people with deep expertise to review it and have input into it. So I was really glad to sort of have them involved too. But basically, we break it up into three components that maybe we could jump off there. So we talk about industry structure, we talk about the nature of sort of occupancy and risk, and then we talk about how companies actually compete. So we could try starting off with each of those three, if that works.
Yeah, I like that. And just for whatever it's worth, and not that anyone would want to drop their hard-earned money on this, I think the origin story of this thing was based on this book, right? Stealing Home. I did drop my hard-earned money on this, but I just, in case anybody cares, to go back to the origin, that I think the ProPublica article was born out of this book, or the book had something to do with the article. But yes, I think, to your point, that's a great jumping off point if we want to start with kind of where you start off in the paper, and then we can kind of unpack from there.
Yeah, sure. So, and I believe that's correct. I haven't spoken to the authors of either the ProPublica or article or the book, but another article written by PropModo explicitly spells out that book was the source of the ProPublica article. So it's one of those things where just somebody's idea got ballooned out into this stuff that's now in Senate inquiries, in in many articles, in 30 different lawsuits that have been filed. And one of the, I talk about this specifically in the white paper. One of the specific things that's quite weird about all of these allegations is that there's this assumption that they make that there's a high degree of consolidation in the multifamily industry. Right. And the sole data point that they use, which I think goes all the way back to that book, is that there is one neighborhood in Seattle
Right.
where 70% of the apartments belong to 10 different owners. And that is the entire basis for saying that, well, this industry is really consolidated. So I spend quite a lot of time looking at that because there's tons that's wrong with that whole idea, right? Because I mean, first of all, it doesn't make sense to define local markets for apartments in the same way that you would for most services, right? If you looked at grocery stores or doctors' offices or garages or whatever, sure, people go to stuff that's like close to them, but for apartments, it's really common for people to be looking at multiple neighborhoods that are miles away from each other, particularly in a city like Seattle where you've got like public transport. So it's
That's
not
right.
so the idea that you could define this one neighborhood as a market in the same way you would with other stuff doesn't make sense at all. But then when you think about that idea, they're saying 70% of all the supply comes from 10 suppliers. Which is like, well, how many industries can you think of where some number greater than 10 companies would be supplying 70% of the supply? 70% of the grocery stores in a local market constitute way less than 10 different vendors.
That's right.
And obviously the glaring thing about it as well is they're talking only about 70%, like which tells you they don't even know what the makeup of the other 30% is. And what if you know anything about apartments, the other 30% is going to be some number way bigger than 10, right? So
That's right.
their sort of go-to example of a really consolidated market is actually a market that's highly fragmented in its supply. So it's the emperor sort of has no clothes when you look at that example. But then if you try as these guys did not do to try and characterize what the market is like overall, there's plenty of statistics out there that tell you exactly what the makeup of supply is in the market, right? So NMHC does this great work every year of putting together these these top 50 lists and you're counting the number of professionally run apartments in the apartment complexes over 5 units, I think, is the cutoff that they use. And there's not a single statistic that says anything other than the fact that this is a really, really fragmented industry, right? If you only look at the sort of professionally run real estate, I think the top 50 owners represent like 11% of the overall market.
That's
So
exactly right.
the 50 top providers only account for 11% of the whole market. And that's once you've removed the sort of mom and pop kind of operations from the sample. The other thing, I've been talking about this a lot this year, ever since the top 50 lists came out earlier in the year. What's very, very obvious is that the average size of multifamily portfolios has been getting smaller and smaller over the last decade, right? So if you look at the makeup of the top 50 owners between 2013 and 2023, I think the average portfolio size has gone down by, I think it's 17% over that time. So what that tells you is during this decade when lending conditions have mostly been highly favorable, tons and tons of new suppliers have come into the market. You have a much more fragmented and diverse base of owners in the industry. And again, that's just looking at the top 50, which we know is a really small share of the overall market. So it's very, very difficult and probably impossible to find any statistic that tells you anything other than the fact that this is an extremely fragmented industry.
I mean, and okay, so now you've just explained the supply side of this dynamic. My imagination tells me that the financial objectives of these, like, say, hundreds and hundreds of ownership groups is pretty diverse in nature and speaks to the same point, right?
Yes, yeah. I mean, if you know anything about revenue management in this industry, just imagine a market where you've got a mixture of big properties and small properties, and some new properties and old properties, and some long-term hold and some value-add repositioning. Like every market has lots of different examples like that. Well, they're not trying to do the same thing, right? If you're if you have if you have a 1,000+ unit portfolio, property, you're terrified of vacancy. Like the risk of vacancy, you dig yourself into holes that are very difficult to get out of. Contrast that to like a 50 unit or like a sub 100 unit property where there's far less downside to taking risks related to pricing. You can't tell those two buildings to do the same thing. They have very different risk profiles. They have very different financial objectives. Overlay on top of that things like, well, a value add repositioning has to make a rent pop on the capital that it's expended on doing this upgrade. So again, they're not going to have the same perspective on what their pricing strategy should be as a long-term hold, for example, that's generally going to look for steady returns and is only going to take relatively low risk opportunities to drive rent. So if you look at all of these different sets of financial objectives that you have, you overlay that onto an environment where you've got many, many, many different types of companies in an ever more fragmented ownership environment. At the same time, the size of fee managed portfolios has gone way up. Like,
Right.
over the same period that the size of ownership portfolios dropped by 17%, you've had like a 60% increase in the size of the top fee management portfolios. So what that tells me is that every property is likely to be part of a smaller portfolio and is likely to have both an owner and an operator involved in delivering pricing decisions. You've got all of this complexity that coalesces around these individual properties. That mean they just can't move in a lockstep. It doesn't make any sense for them to do that. And everything about the way that the industry is organized pushes people in the opposite direction, both strategically and tactically.
It brought to mind, just to speak to the early portion of that remark. I worked for an owner. I think the size of the community is like 980 units, right? He used to call it the aircraft carrier. To speak to your point, right? If you made a pricing decision and you got that aircraft carrier off course, literally in the ocean, it takes about 4 miles to turn an aircraft carrier around and bring it back a different direction. So to your point about you mess up on pricing, it's going to take you a very long time. If you dip occupancies, it takes a very long time to get it back on track versus a smaller community where one or two leases moves the needle. So
Yeah.
let's talk about occupancy, seasonality, risk, things of that nature. Moving over to part two of your paper.
Yeah. So there's this series of kind of innuendos that you see in both the articles, and if you've read the legal complaints, they're in there too, where you see quotes about how companies recognized that they could be more, or they could get greater revenue by dropping from 96 to 94%, or so, statistics like that, which are positioned to sort of sound like companies are purposefully dropping the number of apartments that they're trying to sell in an effort to make pricing go up in the market. Again, they're making this mistake that apartments behave like barrels of oil, right? Where the trouble with apartments is they're just inseparably linked to the building that they're part of, and the way you make pricing decisions is all to do with the financial health of the building that they're part of, right? So if you think about the example that we were talking about a moment ago, the big battleship like property, where you can't risk, you can't risk a drop in occupancy, the unit that happens to be in that building is not subject to the same pricing pressures as the unit that's in a small building where it's not subject to any of those risks. So to think about apartment units as this thing, as this commodity that just moves, with whatever the prevailing tide is in the market, it doesn't make any sense, because the one that's in a big building is going to do a completely different thing from the one in a small building, because that's what the economics tell them to do, right? So if we think about this idea that, well, we can adjust occupancy to increase price, the thing that all of those quotes are describing is different from the thing that they're using the examples to suggest, right? When you make more money as a result of having a lower occupancy, it's because you've managed your inventory more judiciously, right? So if we follow a heads in bed strategy, which would have been the prevailing way that people did pricing before there was revenue management, you basically, anytime there's a piece of vacancy, you fill it with a resident, right? So, and you just drop your price until you've got every single unit full in that building. Well, if we think about an obvious example, so think about like an apartment building in Minneapolis in the winter, right? If you're moving
Sounds
house
cool.
in, yeah, it's going to say if you're moving house in Minneapolis in winter, there's a high chance you just got out of jail. Basically, it's because
Nobody would.
it's not something that the locals choose to do. Right. So what are my choices? So say it's January. I have expirations during that time of year. I have vacancy. My choices broadly are I either drop my prices low enough that I can incentivize somebody to come move in. So that's typically a significant drop in rent. Or I hang on and wait until the market gets better. Right. So if you think about those two choices, the loss that you might make having to incentivize somebody to move in December might well be greater than the money you would save by hanging on to sell that unit to somebody closer to what you would deem to be a fair market rent. The other thing is that if you did drop the price and you succeeded in getting somebody to move into that property, that means that expiration is going to come up again at the same time next year. So it's a problem that you have for multiple years. So the smart thing to do from a revenue management perspective is to trade off, am I better off discounting, or am I better off just leaving the prices where they are? So that if somebody wants to move in, great. Maybe if I can position like a lease of a different duration, it's worth incentivizing someone to do that. So at least that means when that lease renews, it's not going to be in January again. Revenue management, the job of work that revenue management doing is trading off those different outcomes so that you make the pricing decision that ultimately makes you the most money. Now, that might mean that you make more money on that particular unit by having it be vacant for a couple of months, but that is the opposite way round to the thing that they're accusing the industry of. Like the accusation is that people are choosing not to sell that unit because it will drive up the prices of unit, because it will make units more scarce. So what they're doing is the equivalent of saying that farmers who choose not to harvest their crops in the spring are doing so to drive up the prices of their crops in the fall or at harvest time. Do you see what I mean? They're ignoring the fact that you have this colossally important thing like seasonality of demand, which is ultimately this huge driver of behavior. And it's the actual thing that explains all of the quotes that they put into their paper, rather than this nefarious thing that they're trying to make people believe multifamily companies are doing, which of course they are.
So I know we're jumping around a little bit. We're not moving in the flow of the paper, but I'm thinking about all the things that you've just said, and I'm thinking about cartel and the word collusion, right?
Mhm.
And so, talk to me about how extremely difficult it would be to get all ownership groups to come together with the various business plans that you outlined earlier to collude on the idea that we're going to let's call it price fix, right? Or we're going to collude on what pricing should be. How difficult is that? Or what analogy would you use to describe how difficult that is?
Well, I mean, the first thing I'd say is if you've ever sat in on a pricing call, and I've sat on many, like every different revenue management system, user, whatever, I've sat in on their pricing calls and listened to them over the course of many years. And if you listen to the conversation, the idea that anybody would make the suggestion that, well, no, actually we should do this because that benefits everyone in the whole market. That is so ludicrous because it's it's not like it's easy to get people to agree what to do with one property, right? Because you've got revenue management that are making decisions like the ones that we've been describing, right? They're trying to say, what is the next 12 months going to be like? What does my exposure look like over this period? What do my expirations look like over this period? What are the things that we should do that will maximize revenue over this period? You've got your asset managers, for example. You've got people who are extremely invested in delivering the pro forma, right? We didn't talk about that yet, but the thing that is more predictive of what multifamily properties have to do than anything else is the pro forma for that property, right? Every property in our industry represents an allocation of capital to some capital asset, right? These very, very expensive assets that we build, when you invest in them, you do so with a particular thesis, right? This
Right.
is going to deliver returns in whatever way the pro forma says. All of these objectives that surround this big financial decision that's been made are enshrined in this pro forma. And it's the job of asset management, of ownership, of the whatever management team there is to deliver or exceed that pro forma.
That's
Revenue
right.
management is there to make recommendations on how to improve profitability, but they don't get to tell you things that in any way conflict with the delivery of the pro forma. Like you know the idea that there's some revenue management system / people that are telling a room full of asset managers that no, we're not going to do the pro forma thing. We're going to do this thing that we think is going to benefit the whole market. I mean, that would be a very, very quick way to get yourself fired as a supplier because there's no way that all of the financial incentives point towards delivery. People's personal livelihoods depend on them delivering the pro forma for this project that they've been working on, typically for a long time. So the idea that there's some other set of objectives besides that's more important is for the birds, right? It doesn't make any sense at all. I mean, you've increasingly become involved in fee management, right? Did I say anything that isn't now intuitive to you too?
No. What comes to mind for me is the arguing and fussing and fighting. The way that property management looks at revenue management versus the way that asset management looks at revenue management, and the heated discussions that we get in, and no matter if it's for our own book of business or it's our third party property managers, it's like herding cats sometimes to get. And everybody disagrees with revenue management systems, right?
Yeah.
I it's mind boggling to me. You can't. It's hard enough to get five people to agree versus trying to get an outside competitor or many outside competitors to agree on a theory of pricing and the
Yeah,
application of this.
and again, you're talking about one property as well, right? You're
Right.
talking
That's
about
right.
getting together and making decisions about one property. Now, just to go back to the point about feasibility, just the feasibility of doing any of this, right? So you've described how for one property you've got this group of stakeholders that's often quite difficult to get alignment between. So now
right.
what we're saying is let's take our highly consolidated example of 10 different providers plus however many additional ones account for the 30% of inventory that they didn't bother to find out about in the ProPublica article, right? So we've now got to get all of these 20 plus sets of stakeholders around a table to get them to agree to something. One thing we didn't talk about, yes, is it's not like it's that straightforward to do revenue management, to come up with a set of pricing recommendations. So a revenue management system is pulling that property's data. It's doing these calculations to come up with a forecast. It's optimizing, you're trading off all of these different things that you could do with lease pricing. That's analytically hard to do. Like most companies that try to do that usually fail. It's difficult. It's much more difficult than people always think it is. And again, this is for one property. If you wanted to try and come up with a regime of pricing where, well, I now have to include all of the properties in this local market or any number greater than one of the properties in this local market, and I have to trade off their different outcomes, right? Each of those properties has different exposure, right? It has different leases expiring at different times. Therefore, their future availability is all different. So property A, property B, property C, they have different levels of exposure, which means that they should price differently from one another, right? It doesn't make sense for them to do the same thing. Well, now what we're saying is the algorithm not only trades off the different outcomes for one property, it has to trade them off for all of these properties and then trade them off against one another to come up with one set of recommendations that will benefit the market. There is not any algorithm that has ever been designed that could accomplish that level of complexity. And you're talking about sitting in a room with all of these, there'd be hundreds of people sitting in this room at this discussion, and you'd be trying to explain to everybody why the outcome of this incredibly, unimaginably complex algorithm is saying, well, you have to do this and you have to do that. And neither person wants to do the thing that the algorithm tells them how to. But we're sort of being asked to believe that you can snap your fingers and say, yep, these are the prices, everybody. Yeah, it's just absurd. Like it shows to believe any of this stuff, you have to not understand any of how the governance, how strategy, how technology. You have to not understand how any of this works in order to be compelled by any of it.
Leasing teams can spend more than 6 hours every week sending welcome letters, following up, collecting documents, and yet residents still show up on move-in day unprepared. Move-in day sets the tone for the entire relationship with that resident. Getting it right matters. According to Kingsley, residents happy with their move-in experience are 59% more likely to renew their lease. Move-ins matter. Jenna Miller, the Senior Director of Marketing and Customer Experience at Bozzuto, says Updater has been instrumental in helping them remove friction from the move-in process. They rely on Updater to save leasing teams valuable time and create a consistent and branded move-in experience across the entire portfolio. To see Updater in action, visit go.updater.com/Mike. As a thank you to my listeners, Updater is offering a special gift when you book a demo. Move-ins matter. Get them right with Updater. That's go.updater.com/Mike.
Not understand it or completely ignore it, right? Don't let me misspeak here, but my understanding on the backside of any revenue management system, there are some 200 plus or minus levers, and some of those are kind of commonplace: the name of the community, the number of units, et cetera, which is all unique to every community, to your point. But there are a lot of setup levers that to think that every community is going to have all 200 set exactly the same is nonsense.
Yeah, well, it's. We talk about this. So again, as I was thinking about this article, I remembered this 2017 brilliant piece of research that we did at Rainmaker, that actually is this beautiful illustration of how people are actually competing against one another. So just some engineer just came up with this idea that LRO, the revenue management system, had about 200 different parameters, and they're all just little dials to change, something about the way that we treat competition, how aggressive we want the algorithm to be. So creating 200 different dials to figure out how you specifically compete against your competitors would be very odd functionality to create for a system that is apparently designed to make everybody do the same thing, right? so straight away we've got a bit of a problem with this coordination idea. But the brilliant thing about this research that these guys did, they took basically the entire, or almost the entire, user base of LRO, which was thousands and thousands of properties, and they took the settings for these 200 different parameters, and they used this sort of clustering algorithm to group people's settings over time into different sort of clusters, right? The same way you would do a marketing analysis to try and identify market segments or that kind of thing, where you take complex sort of multi-attribute models and you try and identify people who behave like this or people who behave like that.
Yeah.
Well, they basically found revenue management systems or properties who were using their system in this particular way based on the way that they had those dials set. So it's really, really interesting idea, because it doesn't tell you what people should do or what we would like them to do. It tells you for sure what they were actually doing over a period of multiple years. I actually found the article. It's quoted in the paper. But
Yep.
we released this paper, this piece of analysis that we called the archetypes of pricing, because there are basically 5 dominant ways that people use that particular revenue management system, or used it during the period that we analyzed. And it was to go from, I guess, least to most aggressive. We had the occupancy defender, right? So the property that mostly just tries to maintain the same occupancy year round. We had the more extreme version of that, which is like the vacancy allergic, and that's typical. That's like your aircraft carrier kind of property, where you're not just trying to maintain your occupancy, you're doing absolutely anything to avoid drops in occupancy because they're too painful. You've then got what we call the balance pricer. So this was something that maybe something like a long-term hold, like a REIT style of revenue management would probably fit this model, where again you're mostly trying to maintain occupancy, but you're going to be going after relatively low risk pricing opportunities as well. You've then got the
Driver.
You've then got the rent driver, which is that's an interesting one. That's where people prioritize pushing rent over occupancy. You might find that in things like smaller properties where the risk is lower. You will often find that people do things like this temporarily. For example, if a property is being prepared for sale, for example, you might find people pursuing strategies like this. And then you had the lease up, which is a law unto itself, right? Because you have these weird characteristics where you've got chunks of inventory arriving at once, often at relatively short notice. And again, because the pain of failing to lease up in the first year is so sort of acute, if you get into the terrible twos where your renewals are starting to compete against your new rents, like you see very, very radically different behaviors between those 5 archetypes. And the thing that's interesting about it, well, first of all, it's very, very clear that people are using these systems differently. And so it's worth thinking about, why do they do that? Again, if apartments are like barrels of oil, why would people be following these different strategies at all? Everyone would be a rent driver all of the time if it were the case that that we were manipulating to benefit price. Well, the reality is, as we said before, every property in our industry is the result of this capital allocation. It's an investment that's at a different point in its life cycle. If it's new versus if it's getting ready for liquidation, you have very, very different financial objectives, and they call for a different revenue management strategy. You find that these archetypes don't coincide in the same market at the same time. So again, it's crystal clear from the data that people are primarily using revenue management systems to compete against one another rather than to coordinate with one another. And again, if you know this industry, if you've dealt with ownership as you do extensively today, all of this is just common sense, right? you wouldn't really expect it to be any other way, but yet we still have to defend against people who are choosing not to understand.
Yep, that's right. That's right. In the paper, you talk about outperformance and rent increases not being the same thing, which is something I think the article pulled out. But unpack that for us.
Yeah, well, so they set a lot of store by this idea of we outperform the market by X%. Again, if you get revenue management, you get why that doesn't mean what they say it means, right? So for me to outperform the market means two things. One, my performance is relatively good. And two, whatever constitutes the market is doing relatively less well than I am, right? Because when it's a fixed capacity industry, right? So it's not like I can produce way more apartments and sell more. I can't make more money that way. I must be making more money out of my available assets than the other people are in the local market. Therefore, even in a market where everything's going up or everything's going down, there is this sort of zero-sum characteristic about it. I mean, it makes me laugh when you see people using, well, we say that we outperform the market by X%. Like, arithmetic tells you only 50% max people can outperform the market at any one time. And the number of people claiming to outperform the market is way bigger than 50%. Whenever we see claims of outperformance, we should usually be locating the salt closest to where we are. So number one, because it's got this zero-sum characteristic, whether I'm outperforming the market or not, irrespective of how well or how poorly I'm doing, it has everything to do with how I defined the market, like who I chose to compare myself to. The other thing is we don't have a standard metric or a standard supplier of metrics that tells you who's what performance is in the market. So we've got multiple different suppliers of different performance benchmarks, which means that it's in the interests of any operator to cherry pick whatever report shows my property in the best light. So yeah, the idea that outperforming the market is any indication that people are, the allegation that they're trying to make is that people are pushing market prices above a natural level. But if I'm saying that I outperform the market, that's not what I'm saying at all, right? And it's funny that it's a very incoherent thing about what they're saying about what revenue management does, because either revenue management can be helping people to outperform the market, or it can be making the market level go up overall. It can't be doing both, right? It's impossible for it to do those two things. They're orthogonal to one another. So yeah, it's another case where I think the journalists don't understand the basic economics of housing.
Yeah, it brings to mind the heading. And I just flipped to this page. The RM software doesn't make the weather, and you kind of unpack three topics in there. Is that something you can speak to?
Yeah, well, so again, we can say that, and they draw heavily on marketing quotes, like vendor marketing quotes. In fact, they solely draw on quotes from salespeople, and customers on marketing, and often very, very old quotes from people that have appeared on various websites,
Earnings
suggesting
reports.
that suggesting that we use this application to drive rent. Well, there's a couple of things with that. One, very few people who understand this think that that's what you do with revenue management, right? There are occasions when you can drive rent above my competitors, right? So we talked earlier about every property in a market has different exposure levels. Well, what that means is people go through varying periods of what we call pricing power. Like if it's leasing season and I have low exposure, so I have very few units coming available, I have a lot of pricing power. And in that environment, it's appropriate for me to try and make more rent, right? Because I'm in a better position than my competitors are. Conversely, if I have lots of units to sell, I don't really have pricing power, right? I need to fill those units. Therefore, it behooves me to sort of discount. And what anyone who really understands how revenue management works is the thing revenue management is doing is enabling you to do those things more proactively. So you try and end up in more situations where you've got some pricing power and you can make more money, but you do that by dint of, for example, changing your discounting strategies during periods where you want to have fewer expirations, or you want to avoid having holes in your occupancy. So to get to a point where you get to drive rent, you have to do lots of things that are not driving rent, that frequently are lowering rent in order to improve revenue. The way I've said it before is revenue management is about driving rent in the same way that salad is about not having a heart attack. Do you know what I mean? Part of your strategy for not having a heart attack might be to eat salad instead of eating fried food, but there's a great deal more to salad than not having a heart attack. That's the way I kind of think about it.
I'm gonna make that the title of this particular.
Yeah, well, no, it's true, and so the thing is, multifamily, it's property investors. They love to say things like, "Look at all this rent we drove," and so on. It's like, okay, you drove some rent, but you had to give some rent away to drive that rent, and you did that in the form of like all this other stuff that revenue management systems actually do. So that's one thing. The idea that you buy these systems to drive spikes in rent. By the way, I'll tell you, after years of revenue management consulting in this industry, the companies that call and say, we're not making money out of our revenue management system anymore, can you come help us figure out what's going on? Those are usually the companies that have got really high on this idea of driving rent during peak periods. And what always ends up happening is they have to give that money right back as soon as the market flips the other way, because they got high on their own supply. They thought, they were going to keep charging these rents, and then the market told them otherwise, right? So right. It's something that very few really competent revenue managers are boastful of, the idea of driving rents up, because it's not. It's one thing that is a factor of lots and lots of other things that you have to do with revenue management. So that's one thing. But the other thing is that overall, prices don't go up in the market because of revenue management. Revenue management doesn't make the weather. Look at the number of markets where rents have been coming down over the last year or 18 months. Like, what happened there? Did everyone turn revenue management off? Like, how do you explain the fact that rents are going down in lots of markets? So yeah, this idea that we've got some quotes from people, some very enthusiastic quotes about price increases, and that means that revenue management makes the weather. Yeah, none of it's true.
As you were saying that, I was thinking of Jay Parsons. I think this post was from today on LinkedIn, and it shows a graph, right? Or it's a bar graph. And I know it's he's curated a whole range of markets, but we're dipping into the negative rent growth area of, right?
Yeah.
And to your point, I don't think we got together and talked about pushing rents below where they were.
Yeah, exactly. Yeah. So yeah, and that's I mean that sort of brings us into where the paper concludes, which is the sort of thing that's quite sort of angering about this is it's it is actually a distraction from the thing that's really important. Like
That's right.
we have a housing affordability crisis. It's always to do with supply and demand, right? The only solution to housing scarcity is to create more housing. You
Right.
can't make housing cheaper any other way other than making housing more available, assuming demand is held constant. And sideshows like this one, where you got a load of sort of for-profit law firms with these class actions, sideshows like this distract the industry from the thing that's really important, which is building more inventory.
Yeah, I could not agree more. It really is sad because I think at the whether it is a REIT or an independent owner or any number of people that have made their way into the real estate industry as of late, I think there might be some outside of this group, but most people in their heart uh, want to be part of a solution as it relates to finding and creating more opportunities for people to live in an affordable way. Right?
Mm-hmm.
We're
Yeah.
not. The industry is not coming together to say, let's keep supply down,
Yeah. Well.
like
Yeah. It's,
so
exactly.
we can increase all of our pricing. Well,
So.
uh, anything else we should? Is there anything that I haven't teased or you haven't said that we should talk about as an end cap to this conversation?
Well, so one thing that people ask a lot, and I've seen chatter about this a lot on social media, is this idea of like, why is this so different from other revenue management industries? Why aren't people doing this to airlines and hotels and so on? And it's an interesting question. I mean, obviously, you don't have the equivalent of fair housing in those industries, and also it's something. All of those other industries, the product is way more discretionary than like your home. So there are very good reasons why this ought to have a sharper eye on it than other things. But the thing, the guys Donald and Jeffrey and I have are all of a particular vintage where where we've
I like the way
we've been around revenue management for many years, and the thing that in concluding, this is reminiscent of stuff that happened in the airline industry when revenue management was still relatively new. Revenue management started in the airline industry. It started in response to the passing of the Airline Deregulation Act in 1978. So it got under the Carter administration. It was that long ago. But basically, all of these airlines, suddenly their routes were no longer protected, and you had to figure out, well, how do we compete with one another? And that's where revenue management was born. Basically, we have to figure out, we've got these really complex networks of airlines. Well, we have to figure out which things are busy and which things are not busy, and which ones we should put prices up on and which ones we should put prices down. So they figure out this math that really underpins most of what we do in revenue management. And the response, the sort of consumer activist response, was to identify flights where prices were getting really high, right? So that was these airlines are obviously gouging now, because look at these prices that they're these high prices that we're now seeing on certain flights. And the reason why those prices were high was because these were the peak business flights. They were the least price sensitive flights. They were the flights for which there was the highest demand. What the complaints always missed was the fact that for the vast majority of people, flying was getting way, way cheaper, right? That they completely missed the fact that if you look at the air industry now, it's way bigger, it's way more accessible. Far more people are able to afford it than would ever have been possible before revenue management came along. But again, the only thing that the activists and the consumer people want to focus on is that subset of flights where things are really expensive. It's very easy in the middle of a housing affordability crisis to go find residents for whom they're paying way more of their their income than they should be for housing. I mean, that's a tragedy of the way that the industry is right now. But I am as certain that it's wrong to blame the practice of pricing for that, as it was wrong to blame pricing for what was going on in the airlines, which was ultimately highly beneficial to all American consumers.
Yeah, I think that's a good compare and contrast, and it is, to use your word distraction. It really is a distraction to get away from what is kind of, if you think about hierarchy of needs, right? Housing is one of those things that keeps people healthy, both physically, mentally, and helps them to be productive people in society, right? And so we should all kind of gather around that mission and figure out whether it be relaxing regulation where it's thoughtful or thoughtfully done, or opening up other opportunities, rezone, all these things, all these factors that we could talk about, but come together and brainstorm around that, as opposed to come together and brainstorm about why we are potentially colluding to to raise prices in apartments. But Dom, I always appreciate having conversation with you. I always appreciate reading your 20 for 20s. I think I'm 100%, having read them all. I think I am.
Good,
I might be
because
off.
there's more coming. So good.
I take that back. You wrote one about, I don't know how I missed this one, about apartment websites.
Yes.
I totally missed that one. I printed it off today, and I'll
Okay.
read that one, and then I think I'm 100%.
Let me know what you think. It's getting a lot of traction.
Yeah, I definitely will do that. I want to acknowledge the fact that you do, or at least the story I tell myself is, you do a tremendous amount of work and research. Uh, the story I tell myself is, it's a lot of reading, but it is also a lot of talking to people and teasing out a lot of very good content. And so you curate, you do the work to do the curation, and you put together some very thoughtful and insightful articles. And I always appreciate it. I walk away having learned something every time I read one, more than just one thing. I learn a lot. So I appreciate you.
Thank you. Good to be appreciated.
Yeah, definitely. Is there anything you want to leave, whether you end cap with what we talked about today, or any other thing you might want to share with the audience?
No. We're all good. I'm very curious to see how this is received. I've been briefing various people around the industry, so I know it's definitely sort of needed right now. But it's something that I know is very difficult for people to talk about in public. So if anyone has thoughts they want to share, you all know where to find me on social media and so on. So yeah, you feel free to slide into my DMs with any questions about this.
Well, you just sounded like a millennial. That's awesome. Slide into the You are not of a certain vintage that you referred to earlier. Anyway, we will, thanks, Tom. We will link up. I think this is the other article you talked about that does multifamily have distinct pricing personas. So we'll link up to your white paper. We'll link up to that article. We'll begrudgingly link up to the book if anyone wants to go out and purchase that. But I appreciate it. Dom, thank you for your time and investing a little bit of it with us here at the Multifamily Collective. And for everyone else, we'll see you next time on Collective Conversations.
Thanks, Mike.